The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Brillos, and these are your headlines. Oil pulls back as a White House official confirms the US and Iran have mostly agreed on terms to temporarily end the war, with Vice President JD Vance optimistic about the state of play.
Part of what we're trying to do here is really set the stage for a successful negotiation. So I can't guarantee that we're going to get there, but right now I feel pretty good about it.
Today's declines putting oil prices down nearly 20% on the month. US equities, though, posting a record after record in the month of May, while Europe plays catch-up.
Anthropic's latest funding round boosts its valuation by nearly 200% to just under $1 trillion, leapfrogging OpenAI to become the most valuable AI startup on the planet. And a Blue Origin rocket explodes during testing in a major setback for Jeff Bezos' space venture as it seeks to compete more closely with IPO-bound SpaceX.
We seem to have some positive news flow from the Middle East, but again with a dose of caution given how many false starts there have been. The US and Iran have mostly agreed to the terms of an agreement to temporarily end the war, a White House official confirmed to CNBC. However, US President Donald Trump is yet to give his final approval to the 60-day Memorandum of Understanding, while Tehran has not commented. US sources told MS Now that as part of the MOU during the 60-day ceasefire, shipping through the Strait of Hormuz would be unrestricted, with Iran to remove all mines from the waterway within 30 days. The US would lift its naval blockade in proportion to the restoration of commercial shipping and issue some sanction waivers. The MOU also includes negotiation commitments, with the fate of Iran's highly enriched uranium the first issue to be discussed. Iran would commit to not pursuing a nuclear weapon, whilst the US would commit to discussions around sanctions relief and the release of frozen Iranian assets. An end to the war between Israel and Hezbollah in Lebanon would also be discussed. Axios reported that American officials said Iran has signed off on the deal, but noted that has not been confirmed by Tehran. US Vice President JD Vance said he feels pretty good about the state of negotiations.
We'll see, right? I mean, part of what we're trying to do here is really set the stage for a successful negotiation. There are certain details that are going to have to be figured out that are going to take a little bit of time to figure out. There are a lot of details to work out, but what I mean is I think we're making progress. We're getting to a point where we could potentially sit down and settle these issues, but that requires us to make a little bit more progress. I can't guarantee that we're going to get there, but right now I feel pretty good about it.
Let's take a look at the oil price in session. Brent is at 92.96, so hovering just below the 93 handle. We're down 0.8%. We've seen a retreat over the course of the week, and WTI 87.99. Just by reference point, don't forget we're around the 65 handle pre the conflict, so we're still elevated at these levels, but the reversal has been fairly swift. Now, oil over the course of this trading month, you can just see what the May levels look like as a result. Double-digit declines on the WTI price, that 16% along with Brent. So a very strong reversal there, but in part supporting what we've seen in equity markets, where the opposite behavior, very strong trading pattern, particularly for the NASDAQ, Ben.
Now, have a look at these numbers. What do you notice about the three numbers there? They're all fresh record highs. All of the three US benchmarks closing at new all-time highs, building on the rally that we've seen. And you can see as a clue where the main strength of the rally is coming from. No surprises there. It's the tech sector, hence the NASDAQ outperforming the other two. And all of the three main Wall Street benchmarks on course to end the week and the month higher, the strongest performer. Again, no surprises. It is the NASDAQ. Some interesting moves in after trading hours. Dell shares popping 38%. This is after the laptop maker raised full year guidance and reported a first quarter beat both on the top and bottom lines. Markets, of course, they're reacting to the fall in the oil price that we've seen on the month that Karen was just mentioning. easing some of the concerns perhaps around inflation, although we have had warnings this week of potentially higher oil prices to come. We'll get into that more in a little detail later. But let's check in on what's happening in the Asian trading session. And this is the picture on the main indices there. Again, gains to be found, strong gains to be found in Japan and South Korea, also on the Hang Seng, Shanghai Composite, just lagging the others behind. Investors, I suppose, digesting those messages around efforts to resolve the conflict in Iran, although still some uncertainty about the timeline for that. We understand it still needs Donald Trump's approval, the measures that have been pushed forwards and backwards between the two negotiating teams for the US and for Iran. We may get some clarity on that in the coming hours, the days, the week, who knows. And let's have a look at what's being anticipated when European trading gets underway for the last trading day of the month. And this is what the futures are indicating, a positive start to the session. This after the Stoxx 600 closed Thursday about 0.5% lower, looking to end the week fairly flat, but ending the month higher. And the other indices also looking to advance, although the FTSE 100 to a lesser degree. No surprises there, given the pullback we've seen in the oil price tends to weigh on the oil majors, which are big components, of course, on the London index. So that's a look ahead to Europe. Let's have a look ahead to what's being called when Wall Street trading gets underway. And look at that. Incredible. Even higher levels being anticipated on all the three benchmarks, building on the rally that we have seen in those equities, notching potentially even fresher all-time highs. But we'll keep an eye on that as we approach the trading day on Wall Street as well. Karen.
In the meantime, warning signs from the data yesterday. US inflation increased at its fastest pace in 3 years in April, strengthening views that the Federal Reserve will hold interest rates unchanged well into next year. The Personal Consumption Expenditures Price Index increased a seasonally adjusted 0.4% for the month, putting the 12-month rate at 3.8%. George Brown joins us, senior economist at Traders. George, before we get into the weeds on inflation, I just want to get a reaction to the news flow. If we're talking about a 60-day ceasefire now, getting oil moving through the Strait of Hormuz, worth noting that in other situations and other conflicts, we've seen, even if there is a resolution, some ongoing uncertainty. If that were to be the case this time round, what would it do to inflation expectations, how we view the situation?
Yeah, well, I think it's fair to say we've been here a few times before that like this deal just seems to be within grasp. So, but if there is a deal to be made and the Strait of Hormuz is opened, I think, as you say, there's a lot of uncertainty about how quickly that oil can start transiting the strait, how quickly that can come online, and I think given the lead times with shipping containers, with tankers, I should say, it might take some time for that to come through. So we're still going to be looking at quite an elevated period of energy prices. I think, as you say, the question is whether or not that leads to higher inflation expectations. Yeah,
so if we go back to the starting point now, the starting point is 3.8% on the PCE. What does it mean for central bankers that had hoped effectively to be lowering rates this year, now have had to recalibrate and price around the inflation numbers along with the market to a rate hike this year?
Yeah, so I think for the most part, central bankers obviously anticipated that energy inflation would be at this level, given where we've seen energy prices evolve. The question really is whether that starts to bleed through price and wage effects. Now, much like the central bankers will be keeping a close eye on that, and we think for the most part we're not seeing any signs of second round effects, any signs that inflation expectations are starting to de-anchor. So unless that is going to be the case, we think that for the most part, central banks are probably going to talk tough, but actually refrain from hiking rates. Now, clearly, as you say, there's a lot of uncertainty, though. So if a deal isn't within grasp and we do see a continued disruption that continues on, the risk is clearly higher that we get those second round effects.
George, when you look at sort of the bigger picture and the situation, I was just referring to the all-time highs. I mean, I've lost track of how many there have been clocked this month alone on the Wall Street averages. And yet, we are a month further into depleting the stocks of drawdowns available to cushion the energy supply crunch. In terms of when that starts to sort of butt up against the optimism that we're seeing, what are the timelines and sort of How soon does that potentially become a problem that starts to cause nervousness around inflation feeding through to the second round effects that you mentioned?
Yeah, it's a great question. As you say, we're close to record highs. I think if 3 months ago you'd said that the Strait of Hormuz would still be closed, you'd be quite a brave person to say we'd be touching record highs now. In terms of when those kind of flows are going to arrive, I think it's about 20, 30 days normally that tankers take to arrive. But as you say, we've still got those stockpiles that are being depleted. They can probably go a little bit further. So in terms of that disruption, I don't think we're there yet. I think it's going to take maybe another month or two until we really start to see those crunch. So I think it's by the skin of our teeth. I think we're going to get through it. But like I say, it all just depends on whether or not this is actually a deal, because we have been here quite a number of times, and overnight we've seen obviously a re-escalation in terms of the conflict, in terms of fighting as well. So I think it's quite tentative whether we get a deal or not.
And then in terms of your view on what we can expect under Kevin Warsh's chairmanship of the Fed, do you think we're going to see any drastic changes or not? Yeah,
so I think there's a lot of people in the market who have latched onto this sort of narrative. I'm not entirely convinced that this is going to be the case. Of course, he's had to sound quite dovish in his testimony and in terms of his nomination process. He does have this view that AI is going to be disinflationary, and that could well be true, but I think that's going to be a massive punt effectively, given that we're not really seeing that in the data yet. So I think one is he's going to struggle to convince the rest of the committee that that's going to be the case. But I think the rest of the committee as well, if you listen to the Fed speakers in the past week, because we're about to go into the blackout period, the quiet period in which the Fed doesn't speak, a lot of them are sounding hawkish going into the June meeting. So likely they're going to be on hold. But like I say, I think it's going to be a really tough challenge for him to convince them that they need to cut rates in the next year.
This is where it gets interesting, because the jawboning that you're discussing from the central banks, and we've seen it from the ECB as well, it's a powerful tool to be able to talk up the prospect of rate hikes, but actually sit back and do absolutely nothing. And you've seen as a result, it's been baked into bond markets, this hawkish view from a number of central banks. Walsh is almost sort of shooting himself in the foot by taking away that hawkish rhetoric, the ability to just talk tough without doing anything. When you look at what's baked into bond markets now, do you think there's going to be some mispricing because investors have had to react to the language, the rhetoric from some central banks?
Yeah, there certainly could be. I think this jawboning, as you sort of say, it is a powerful tool, but obviously it can go both ways. I think the issue is, and it keeps coming back to this, and I think we're going to sound like a broken record, but when does the Hormuz Strait get resolved, and where do oil prices evolve from there? Because that is largely going to dictate what central banks are going to have to do. Because one thing we haven't touched on is that, yes, there's oil prices, but then what does that lead on to? So food prices are probably going to be the next leg of inflation. And if you look at agriculture pricing in markets right now, that does look fairly complacent, given that fertilizer prices have risen quite a lot. And then if you look at weather conditions as well, you've got drought conditions in the US, and it looks like it's going to be a super El Nino year as well.
So why is the US 10-year Treasury yield now pulling back? We've been looking at that chart, and I know we had a lower growth rate that came through in the first quarter than expected. Why is that long end of the curve starting to come back a bit, given all the debt loads?
I think the market is purely trading off of everything that's happening in the Hormuz Strait, and I think it comes back to what Ben's saying, that what happens that once we do get this resolution one way or another, how does the market then trade off the back of that? But for now, the market's very short-termist. One thing I would add on the GDP numbers as well, even though we got that downgrade, the problem is you've got this massive volatility in the GDP numbers over the past year, partly because of the tariff front-loading that you see in Q1 last year, but then obviously you had the government shutdown. So our preference is to look at private final sales. And when you look at that, they're running at 2.4% growth. So the US economy, from a growth perspective, looks fairly solid going into this crisis. And so turning to what's the Fed going to do? Well, from the most part, when we look at our screens of who's most at risk of second round effects, the US is the one that's screaming that it's got capacity constraints. So that is the one out of all the central banks that really is at risk, I think.
Hey, George, thank you very much indeed. Really good to get your thoughts as always. George Brown, Senior Economist at Schroders. Coming up on the show, a funding round sees Anthropic almost triple its valuation, will bring you the eye-watering number. Plus, Blue Origin's new rocket explodes on the launch pad, dealing a setback to the space ambitions of Jeff Bezos. And we'll cross live to this year's Shangri-La Dialogue in Singapore, where Sri will be speaking to New Zealand's Defence Minister.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Well, SpaceX could reportedly settle on a valuation of at least $1.8 trillion in its upcoming IPO, lower than some figures previously reported, according to Bloomberg. Discussions with advisors and investors are ongoing ahead of the roadshow, which could reportedly start next week, with a final valuation not yet confirmed. Separately, CEO Elon Musk appeared to muddy the waters yesterday, posting on X that a major computing deal with Anthropic was actually only a 180-day lease. That's in contrast to SpaceX filing last week, which characterized the agreement as being worth up to $45 billion. Anthropic itself has raised $65 billion in a funding round that nearly triples its valuation to $965 billion. For comparison, rival OpenAI is worth an estimated $852 billion. New funding for the maker of the chatbot Claude includes investments from memory chip companies Micron, Samsung and SK Hynix, among others. Anthropic is an end customer for their hardware. London has reclaimed its position as Europe's leading technology centre in Dealroom's Global Tech Ecosystem Index, thanks to increased venture capital investment and continued unicorn creation. Joining us now is Yuri Kinkaras, who is the CEO of Dealroom. Thank you so much for joining us, Yuri. I want to get into why London is doing so well. You see it in numbers in terms of CapEx spend. In your numbers, it's ranked very highly now as well. Just walk us through some of the strength you're seeing.
London has always been the top tech ecosystem in Europe, but what you're seeing lately is a return to concentration. And so, for example, in the US, you see a return to concentration within the Bay Area, and you're seeing the same effect in Europe. So, for example, Google has its DeepMind operation. I think that's really functioning as a kind of magnet for AI talent and AI startups. And that's what you're seeing now in London. So they're benefiting from that.
It's one thing to have the innovation and to have some early success, and it's another to see scaling and the businesses that have been created here staying here and then eventually listing on the markets. Is there any sense that some of the early success that London is now enjoying will actually go the whole way?
Yeah, that's the big question. And of course, you're like the UK now not being in the EU, I think doesn't really help. Having said that, the business world is just moving along. There is a question though around capital. So the big difference between the US and Europe, and including the UK, is that in the US, there is much more long-term investment happening, also by pension funds, for example, and insurance companies, whereas in the UK, those same pension and insurance funds are predominantly investing in fixed income. And to the extent that they do invest in equities, it's often public equities and even often US equities. But if just a small portion of that of those assets could be invested in European innovation and UK innovation, then it could go a very, very long way. And think of things like fusion energy, things like autonomous driving, but also frontier models, like the science and kind of early stage technology is really at the forefront in the UK. But yeah, to really go to the next level, more capital is needed.
Yoram, I know what you say about London being Europe's leading tech ecosystem, but just help me understand what does that mean? What are the metrics that lead you to that conclusion? Is it based on number of startups, certain valuations? How do you reach that conclusion?
Yeah, it's a bit all of the above. So if you look at the amount of venture capital that's being invested into UK startups, the UK attracts about the same amount of venture capital as Germany and France combined. Sometimes you can even add a few more countries, depending on the year. This year especially has been remarkable. Almost half of all venture capital invested into Europe goes to the UK. It used to be about a third. This year so far it's half, so that's really remarkable. But also, if you look at the outcomes, actually, and that's maybe even more interesting. So, if you measure the startups that have raised venture capital and then go on to go either public or have a successful exit, if you add up the enterprise value of those deals, nobody comes even close, and there even the lead over the rest of Europe is even larger.
And so London's leading the pack at the moment. Where should we keep an eye on? Where might be snapping at London's heels as a potential future rising star city?
So can you, I don't understand what you mean by that.
London is the leading tech ecosystem at the moment, but where else do you see signs of promise, of momentum that could potentially, creep in on London's lead and give London some competition?
I mean, within Europe, Stockholm is doing really well. There have been a number of very successful AI companies. One of the fastest growing startups ever, Lovable, you've probably heard about it, is from Stockholm, but it's really not the only one. Paris has been really on a rise. If you compare it with 10 years ago, it is nothing like it. Just around London, you have Oxford and Cambridge, of course. So I think that golden triangle is there's no other place like it in the world. And I would say that's like actually a key conclusion also of our report. Of course, it's nice to rank cities and it's nice to be number one. But I think for Europe to really succeed, we have to kind of zoom out. If you zoom out, you see that all these cities, all these tech ecosystems in Europe are super close to each other, usually not more than 2-hour flight, which on a global scale is nothing. So we should try to look at these ecosystems also as one cluster. That's actually how the venture capital world already operates. It's just not how maybe politicians always operate. Those cities together are on the same scale as the Bay Area in many ways.
The VCs that I'm talking to saying that a lot of the money is going into deep tech and it's dual use defense between what you're seeing on the front line in battle, but also with civilian tech. What are you hearing on that front? And do you think that's going to be the next frontier where investors keep chasing that theme because there's so many European funds available to go into that area of technology?
Absolutely, and that is so important to realize. I think every industry often chooses its place where everything happens. So it used to in finance, it's New York and to an extent London, maybe Hong Kong. In the 1800s, you had cutlery was done in Sheffield. For the last, let's say, 20, 30, 40 years. The semiconductor and software industry have decided everything needs to happen in the Bay Area. But now we're shifting from computer games and social media to AI, which is going to permeate everything that we do. Defense tech, you have energy tech, security. These things are kind of becoming vital for every country. So that's why it's so important that Europe also decides, okay, we have to build our own tech ecosystem, and there's going to be always a lot of collaboration around the world, but there has to be some sense of sovereignty, and I think especially you are going to keep seeing that in areas like defense tech, resilience more generally, energy, and so forth.
Yeah, it's quite a message, isn't it? Jeroen van Kaarten, thank you so much for joining us, CEO Deal Room.
Dell shares surged in extended trade after the company reported its fastest sales growth since returning to the public market in 2018. The stock was already up 150% for the year as of Thursday's close. It posted an 88% increase in revenue in Q1, driven by demand for its AI servers. Dell said it had more than 5,000 AI server customers, including neoclouds, sovereign clients, and enterprises. Amazon is reportedly shutting down its internal leaderboard that tracked employees' use of AI tools. This is according to the Financial Times, citing sources familiar with the matter, who suggested the move came after workers tried to boost their scores with unnecessary use of AI tools. Employees have reportedly now been told that the pointless tasks meant additional costs for Amazon and that they should, quote, not use AI just for the sake of using AI.
Well, this is a fascinating turn of events, isn't it? And there's another story that's linked to this, as company leaders are reportedly starting to question whether the rising cost of using AI is delivering any meaningful returns. That's according to Axios, which says one consultant told them of a client which spent $500 million on AI in a single month after failing to put any usage limits on employees. It comes after Uber's CEO said that AI costs are, quote, getting harder to justify, following comments from the company's CTO that they had already spent their yearly budget for Claude Code by April this year. And don't forget, a lot of these companies had told their employees just to experiment, to go with it, use as many tokens as they wanted. But now they're coming up against the cost. And even if, as a personal user, you can see you put in so many chats and eventually you're at a pro subscription after very limited usage. And I think this is the thing. We're now seeing the cost of using these types of technologies. And you need to be quite rational. Does it need to go into a basic search engine or does it need to go into a pro system?
Yeah, it's the oldest tactic in the corporate playbook, isn't it? You give people a free unlimited use trial, you get them hooked, you get them reliant on it, and then you come in with a subscription and the limit and the price. And by that point, whether it's individual consumers or businesses, they have woven this so deeply into their workflows and their processes that actually they almost have no choice but to pay the subscription or to increase the number of credits they've got to use the platforms.
I mean, the system is so advanced. It's, I mean, there's all different types of analogies you could make, but it's like giving someone who's just got the keys to a new car, or just got their license, and giving them a brand new Ferrari, Lamborghini, or very high-end sports car to drive. That's not where the capability is right now. You give them some sort of basic car while they get the training wheels on. This is the same with search, where some of us are using AI search for very basic means when it should be preserved for the most sophisticated means possible. I think that's where the burning through the tokens is happening. So some sort of AI strategy at a corporate level, no doubt welcome. We are coming up to the start of the Friday session, 30 minutes to go. Early picture looks stronger in areas of the market, 50 futures, DAX futures, not on the FTSE, and that no doubt reflecting the retreat in oil prices as we talk about the potential for a 60-day ceasefire and a breakthrough around the Strait of Hormuz.